G'day everyone. I'm sure if you are following the market that it's likely you're seeing headlines like this one about a stock market crash in 2017 or 2018, because there are a lot of people who are writing these sort of stories and headlines, and for the most part they're attention grabbers or they're trying to sell you something. What I want to do is give you the facts about market tops, significant tops in the market, show you why a market crash is absolutely nowhere in sight, and most importantly, how you can avoid a market crash in the future, because at some stage in the future there will be one, but how you can avoid one quite easily in the future just by doing a few simple things. So these are the reasons why you shouldn't worry about a market crash. There are a number of factors that lead to major market tops and therefore ultimately a market crash from time to time. But there are three main precursors that are almost always required in almost every market top and crash. The first one is that sentiment needs to become sufficiently bullish or euphoric to indicate that the majority of the money is in the market. People start to believe that the market can't go down, it can only go up. And at the moment, that's just not the case. I mean, we've been moving through, since the last GFC, we've been moving through a period of disbelief, of hating the bull market. There's been a whole range of different emotional states of the market. And I think my sense is that the market is only just recently, in the last couple of months, reaching a level of acceptance that things are actually pretty good in the stock market. We're a long, long way from that euphoric stage that normally marks a market top. The second thing is that almost every market top and crash corresponds to the onset of an economic recession. That is the fact about it. And for the first time in probably nearly 2 decades, we have global synchronized growth with all the main OECD countries all expanding their economies at the same time. None better than the American economy. And if the Trump tax reforms get through, the stimulatory effect to the American economy is going to be extremely significant. So there is just no prospect of an economic recession whatsoever. The third thing is that money always flows to where it is treated best. And there's a relativity between the yield from stocks and the yield that you get from the bond market. And at the moment, that differential is still sufficiently wide to be heavily in favor of stocks. There is just no incentive for thinking people to be in bonds as opposed to stock when they weigh up the potential reward for the risk. So that one's not even close. So the three main precursors are absent. That's the first point. The second point, and most importantly, because fundamentals can be misleading in the short term, and fundamentals can also lag. So it's the charts that give you the most immediate feedback about what's happening in the market. And the charts continue to demonstrate an extraordinary strength of buying that is showing no signs of waning. And what you require leading into a market top before a crash is a change of character. It always happens, and I'm going to go through in a minute and examine the major market tops that we saw in 2000 and in 2008 and show you what I mean by a change of character, and how at the moment there is absolutely no change of character evident at all. In fact, the market has never been stronger. So there is, contrary to a change of character, there's actually very clear evidence of very powerful buying support. Now, the third point that I want to make is that it takes time for these circumstances to change. So we've looked at what the main precursors are. They're absent. And we're looking at the current charts, and there's no sign of a change of character. And those things just don't change overnight. Sentiment can't flip overnight. You've got hundreds of millions of people involved in the stock market around the world. They don't just suddenly wake up one morning and decide to have a different outlook on the market. It takes time for sentiment to change. The next thing is, similarly with economies, they don't just suddenly go off the boil. We've got economic expansion all around the world, and that economic expansion is accelerating. It doesn't just suddenly go into a recession. The next point is that interest rates have been under very strict control for the last decade, and it would appear that central banks, may have pulled off a degree of success. The jury's still out on that, but they may have pulled off a degree of success, albeit they're passing the debt down the line to future generations. But nevertheless, they've managed to hold the global economy together. And it's just impossible for me to envisage that central banks are going to raise rates at a rate that would compromise that economic growth. It's just not going to happen. Central banks are not going to let all their hard work over the last decade disappear. If interest rates become a problem, they'll bring them back down again. So what about a correction? Yes, there will be corrections along the way, and we're talking perhaps 10 or 20%, but that's not a market crash. And that certainly won't be the case. There will not be a market crash in 2018 because too many things need to go through a progressive evolution before that could happen. But there will be corrections, and you should trade what you see until the signs change. But I will make one point about the market currently. A lot of people are looking at the market action and saying that it just can't continue to go on like this at the index level, where the indices just keep going up and up and up. But in actual fact, there is a sort of a correction by stealth happening at the moment. In America, it's happening at a sector level. So we're seeing sectors go through certain corrections. Right at the minute, the technology sector is going through a correction where a lot of the major stocks are down between 10 and 15%. Yet the index is unaffected because that money is merely rolling into other sectors. And so we're getting this sort of correction by stealth. And so therefore, it's quite possible that the market indices could just keep advancing in the slow and steady fashion that they've done all year. So again, this comes back to the critical point. You must trade what you see until the signs actually change. A lot more money is lost, and there's been studies, numerous studies into this. A lot more money is lost by people trying to avoid corrections rather than the actual corrections themselves. So it's just so important to trade what you see. So let's jump in and have a look at the S&P. What I want to do is show you what a change of character looks like, and then to examine exactly where we are at the moment. So what I want to do is examine these two periods here, the peak in 2000, and then of course the peak in 2008. So you can see the market dropped from, the S&P dropped from around 1550 down to 750 in 2000. And in the GFC, it dropped from 1550 down to just below 700. So let's look at these two periods initially, and I'll just tighten right in here. So we'll look first of all at the period leading into 2000. Now you'll notice that the red line, the 200-day moving average, was heading up very, very strongly. And other than a correction that we got in 1998, which was associated with the Asian currency crisis and the Russian default, the market remained consistently above the 200-day moving average, and for the most part, the blue line, the 50-day moving average, was above it, and the price was fluctuating either side. Now, it wasn't until we got into late 1999, in September, that we started to see some change of character that we hadn't seen for most of that period from 1995 onwards. And then we come up here and we start to see some significant wild swings in the price. And I'll just tighten in a little closer here. And you'll see that the range of these candles starts to get a lot bigger. We're starting to get wild swings like this here and this day here. The candle ranges are much bigger. We're now starting to go down below the 200-day moving average a bit more regularly. So rather than back here where it was not at all, we've now got it here and then here and here and again here. So eventually the market got to a point where the 200-day moving average had rolled over. The price is now spending most of its time below that 200-day moving average. The 50-day moving average has cut the 200, and we start to break down on these swing lows. So this is the swing low. This is when the market started to get really volatile in April of 2000. We're still only 150 points off the peak. So as long as you hadn't been doing a lot of buying in this area here late in the piece in 1999, then you should have still been broadly in profit. So this was our first warning sign that the market was changing character. So you had plenty of time, and ultimately the ultimate confirmation occurred here in December of 2000. But even then the market did bounce back a bit. So you had more than enough time to escape the majority of that major peak in 2000. Let's wind forward now to 2008. Just remove that so you can see it more clearly. So again, we've got a major run up, the red 200-day moving average line heading up very strongly. The index goes below it very briefly and only occasionally. 2004, 2005, 2005 again, 2006, and that's about it. So the average, moving average, still rising very strongly. Here is where we start to get some wild fluctuations. You can see the plunge in the S&P fell from 1558 down to a low of 1371. So that was our first warning sign that the market may have been changing character. Now, as long as you didn't panic, there was plenty of time to get out, plenty of upside, and a lot of time to stop buying, to take profit, and overall reduce your exposure. Let's move forward by this period here. So we're talking December of 2007. So we're still well before the worst of the GFC, and we're only a small distance from the top. We're now starting to see the price below the 200-day moving average most of the time. The 200-day moving average is now flattened out. The 50 has cut it. We hadn't seen that for most of this period back through here. So clearly a change of character, bigger range candles, lots of wild fluctuations, and we're starting to get lower lows and lower highs. Here was the ultimate confirmation. It occurred in January of 2008, and then basically the market completely fell over and we had the GFC. So hopefully you can see that there's plenty of warning sign just by using a couple of very simple indicators. Now let's look at where we are now. 200-day moving average moving up very strongly, the 50 equally very strongly above it, and the price comfortably above both of those. So there is absolutely no indication of a change of character in this market at the moment. And when you couple that with the other things that I talked about before, which is the major precursors being absent, and the fact that it does take a long time for things to evolve and things to change, it's really hard to see there being any sort of major market peak or market crash in 2018. So if you wish to follow my weekly update videos, I do this identification or this monitoring of changes of character. I do it quite regularly. I do it about 4 or 5 times a year as required. So I'm going to continue to do that. So if you follow my weekly updates, then you're going to know about a change of character as soon as it happens. You're going to know how to prepare for it, to what degree you should stop buying, to what degree you should start reducing your exposure to the market, and And hopefully in those weekly videos, I also give you a lot of factual information and perspective that helps you shut out the media noise. And that's really half the battle for investors is really battling the media noise and what's going on in their head. So I hope you found this video helpful, and I'll look forward to seeing you on my weekly updates. Cheers.